Hey everyone, Jeff Dorman, Chief Investment Officer at Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about everything happening in the crypto markets as we do every week, and have done now for about 7 years, both on our blog, That's Our Two Satoshis, as well as here in our 10 to 15-minute videos. So look, it's been summer. I'm sure a lot of people have been in and out. We actually missed a couple of these as well. So I'd encourage people to actually go to our website and look at some of the recent blogs. We've written a lot of really interesting things lately over the course of, call it 2 months. We talked a lot about Ethereum's ecosystem and how it's soaring, but how a lot of other areas of growth in the crypto market it is growing just as fast and maybe is a little underappreciated. My partner, Topher McPherson, wrote a great piece about internet capital markets and why we think that every entity is eventually going to issue a token, and how tokens are the greatest capital formation and customer bootstrapping mechanism ever created. And it applies to much more than just protocols. Your local bodega, your local barber, your local gym, all startups really should be issuing a token. We talked a little controversial piece. We wrote a lot about how layer one protocols are really certainly misunderstood, but also really hard to value in the sense that if you look at some of the parts analysis of the fees generated combined with the amount of tokens that need to be held in wallets, combined with the social or hype factor, it's really hard to get to a lot of the valuations we see on current layer ones. Doesn't mean they won't go higher. It just means that, this is really one area of crypto where it's just pretty impossible to value, whereas a lot of the other areas, like DEXs are much easier to value. We've written a lot about what the future of asset management in crypto actually even looks like. Now that you have ETFs and digital asset treasury companies, talked about where active management can still come into play in terms of on-chain analysis and some of the more specific ways to generate alpha in the on-chain world relative to what's available through the ETFs and DAFs. And then, of course, probably our most important piece we wrote, where we talked about a proposal about adjusted market cap standard, really just highlighting how wrong the metrics are that people are using for valuation techniques now. You can't use market cap, you can't use FDV. The answer is somewhere in between. And we wrote a whole piece about that, as well as talking about the facts and myths around digital asset treasury companies. So I really do encourage everyone, go to our blog, ar.ca/blog. Look at some of the content we put out recently. I think it's really helpful as we get into the end of the year here in terms of crypto investing. But in terms of this last week, obviously a little bit of a softer week. Actually, depending if you go Friday to Friday or Sunday to Sunday, there really actually wasn't that big of a week over week decline. It's just that, starting Thursday and Friday last week, we had a lot of the wind taken out of the sail of some digital assets. The Triple C rally really stalled, meaning a lot of the worst of the worst tokens that were kind of leading the gains in early August started to really pull back. But most of the other pullbacks are pretty muted. Like Ethereum down 12% now from the highs, Bitcoin down 8%. This is not your typical kind of crash and burn. This is just a slow retrace after a pretty big move over the last 3 to 4 months. So it feels pretty healthy thus far. Obviously it can change, but right now feels pretty healthy. We also pointed out, I think the bulk of the world thinks that crypto is on fire this year because they're looking at Bitcoin and they're looking at, some of the crypto stocks, things like Coinbase and Circle and even Bullish, if you count that. They're looking at the recent run up in ETH, but a pretty good chart that we used from the CoinDesk indices showing that this really has been a horrible year for crypto investing outside of a few assets. So a few large caps, your Bitcoins, your ETHs, your Ripples, a few other things like Hyperliquid have done really well. Most things are still down and down quite a bit year to date, even as you've seen strength in others. So still kind of a polarizing year. I do expect that if we see strength in the end of the year here, especially after Jackson Hole this week, if you start to bake in rate cuts and some easing monetary policy and eventually a new Fed chairman, you probably do see a little bit of a rally in some of the other areas of the market that have been undervalued and certainly underexposed relative to how much love is happening in this crypto equity market right now. But more specifically, what we really focused on this week was just the amount of vertical integration that's going on in crypto. So, again, we think layer one protocols are incredibly hard to value. That doesn't mean they're not valuable. It just means they might not be as valuable as the market cap of their tokens. But if you see what's happening now across the entire industry, there is just a race to build your own layer one. So last week you saw Stripe announce their new EVM compatible blockchain called Tempo. which was going to be designed specifically for stablecoin payments and enterprise adoption. On the heels of that, Circle came out, who obviously is the issuer of the USDC stablecoin, and they unveiled Arc, which is their own EVM-compatible layer 1 protocol. You've seen much more of this, right? Hyperliquid started as a DEX and then has their own Hyper EVM. Earlier this year, we saw Tether and Bitfinex announce Plasma, which is going to be their own blockchain aimed at settlement and financial infrastructure for Tether and other blockchains. It's really pretty much everywhere you look, you're starting to see these companies that have some level of success, largely around stablecoins, because that's been the most successful app thus far in crypto. But any company that's had some level of success is now saying we want to own the whole stack, right? We don't want to just earn the fees on our application. Now we want to own the sequencer fees and the transaction fees on the blockchain itself. And this is not a new concept. You go back to Cosmos, most of you have probably forgotten about the Atom token because it was such a poor performer from an investment standpoint. But the idea that Cosmos was trying to champion was that, basically sovereign blockchains, that using the Cosmos SDK and the Tendermint consensus engine, that everybody should have their own blockchain, which is exactly what Stripe and Circle and Tether and Hyperliquid and everyone else is trying to do. DYDX famously moved from an Ethereum app to building their own blockchain on Cosmos. Didn't go very well because DYDX basically has melted down as Hyperliquid and others have kind of taken over the decentralized derivatives realm. But again, the idea of owning the vertical integration, owning the full stack, was something that's been around for a while. And we think it probably continues based on what we're seeing. But the jury's still out on whether that's the right idea or not, right? Meaning, is there any real benefit to having your own chain that is enough, or rather, we know there's a benefit to having your own chain. Is the benefit of having your own chain enough to outweigh the benefits of building on someone else's chain that already has all of the distribution and all the users? So there are examples who are doing that as well instead of building their own chain. So let's look at Coinbase, for example, right? Coinbase, obviously all about vertical integration within its core business, but they deliberately decided to launch Base as an Ethereum L2 instead of a new L1 because they aligned with Ethereum's liquidity, the developer ecosystem, and everything else that Ethereum already had. Similarly, Robinhood is building on Arbitrum, another layer 2, right? So there are entities like those that have decided that rather than building our own chain, we just want to integrate with an existing Ethereum-based chain. Coinbase also, on their second quarter earnings call just last week, Brian Armstrong explained how Coinbase is going to start integrating decentralized exchanges like Aerodrome. Basically, Aerodrome will be the destination DEX for Coinbase's ambitions to tokenize stock and other assets. So the old model of Coinbase Exchange, which was just to generate exchange fees for trading, the new model will allow them to benefit in three ways, right? The exchange fees, the sequencer fees on Base, as well as being an owner in Aerodrome via their Coinbase ventures. So the idea is there's not a one-stop shop for how to do this vertical integration, but it's clear that everyone is recognizing that you want to own as much of the overall business as possible, not just your application itself or not just your DEX itself, but you want to own the entire chain, the fees, and everything that goes with it. So it'll be interesting to see what happens. It's very similar to what we saw in the tech, right? Amazon and Apple built vertically integrated stacks to their own distribution, hardware, software, and payments. So crypto companies doing the same thing is not, super unprecedented. But again, we just don't know. We don't know how powerful the network effects of something like an Ethereum or a Solana is. Where is it really beneficial to be on that chain, or if you already have your own users and your own application, can you just build your own chain? So that's, I think, the probably biggest story over the next 6 months. You really have to monitor how these new chains will do. I certainly think, Circle probably not big enough or important enough, but Tether probably is, right? So we'll see how Plasma chain works, and does a majority of Tether start to move off of Ethereum and off of Tron onto Plasma? Because if it does, obviously you'll see a lot more of it. If that fails, then I think it'll probably be a pretty big nail in the coffin in support of not having your own chain and just building on top of someone else's to benefit from their network effects. So we'll see. It'll be interesting. Obviously, none of that really is what driving market prices this last week, but it's certainly probably the most important story as we head into the fourth quarter and even into 2026. So as it pertains to price action this week, obviously a little bit skittish, both in equities and in crypto. Not really seeing any panic, though. 10-year rates aren't really moving. The dollar is not moving. Gold's not moving. The VIX isn't moving. This seems pretty much just profit taking, or even maybe a mid-August, summer holiday buyer strike, more so than any real panic. But we'll know more at the end of the week after Jackson Hole, and we'll see if the buyers that have been driving crypto for the last 4 to 5 months are post Labor Day. So that's it for this week. We'll be back again next week. Thanks, everyone. And like I said, please check out the blog on our website, ar.ca/blog. Thank you.